Welcome back to the Money Advantage podcast. Today we have a very exciting and interesting conversation for you because we're really talking about life insurance, which you hear often on the Money Advantage podcast. We're bringing it in to a different context from a different perspective and really helping you understand how it fits into a retirement plan and makes everything better. So what I want to start with is by sharing, we have Dr. Wade Pfau joining us for a second time on the Money Advantage podcast to unpack this wonderfully. Dr. Wade, thank you so much for joining us today.
Oh, it's my pleasure. Yeah, thanks for having me back on the show.
Let me read just a little bit of Dr. Wade's bio for you so that you can get some context for who he is and why not just his opinion or his perspective, but his research matters and really is substantiated. So I want to share that with you first. So Wade D. Pfau, PhD, is a CFA and RICP. He's the program director of the Retirement Income Certified Professional designation and a professor of retirement income at the American College of Financial Services in King of Prussia, Pennsylvania, as well as a co-director of the college's Center for Retirement Income. So as well, he's a principal and director for McLean Asset Management and RISA. Is that how you pronounce it? RISA? LLC? RISA LLC. He holds a doctorate in economics from Princeton University, and he's published more than 60 with a 60 peer-reviewed research articles in a wide variety of academic and practitioner journals. He hosts the Retirement Researcher website, so you can find him there at retirementresearcher.com. And he's a contributor to not only Forbes and Advisor Perspectives, but also the Journal of Financial Planning. And he's been an expert panelist for the Wall Street Journal. Wade's newest book is Retirement Planning Guidebook, Navigating the Important Decisions for Retirement Success. So what you can hear from that is tremendous background of knowledge, very learned and very well published and very, there's a word I'm looking for, but very substantial in this field of retirement planning. And yet we're talking about life insurance and how that fits in retirement planning. So this is really a conversation to listen up to, specifically because we hear this sentiment all the time. You know, I need life insurance until I retire, and then I don't have a need for life insurance anymore. My house is paid off. My kids have been through college. I've already handled that. I don't have a life insurance need. And today, what we're going to do is really show you how life insurance can be a crucial and key component in a retirement strategy that's more effective because it creates more retirement income and it gives you tremendous value and advantages in creating a legacy as well. So we're going to unpack that today. But Bruce, just before we jump into that, can you share from your perspective? I know you've known Dr. Wade for quite a while. Can you share from your perspective the value of why someone should really listen in today?
Well, I think the word you were looking for is credibility.
Yes.
And Dr. Wade brings that from all his research. Dr. Wade would probably agree with me. When you work with certain analytical people, in our industry, they need that research to reassure them. And that's why I love to use his white papers. Dr. Wade, I was just at a Jackson National Life lunch yesterday, and they were actually talking about some of your research at the lunch. So I think, and that's here in St. Louis. So he is very well respected throughout the retirement planning community. And the reason he's well respected is because of his research. And I think that's very comforting to a lot of people. Now, we don't espouse, we try to actually get people to work longer, because
yes.
We think we want people to get into a life where they are in a business or they're in a career that they love and they continue to flourish and so on and so forth. And that actually helps retirement planning. I'm sure Dr. Wade that doesn't take a rocket scientist to figure that out. The shorter your time period for retirement, the easier and more likely you're going to have a good retirement. But Dr. Wade, I think one of the things that I'd like for you to kind of kick off here today is the current economic situation here in 2022, in the spring of 2022, going into the summer. And what are some of the things that people should consider? And I'm specifically talking about one of the things in your white paper, one of the things that we espouse and you do too, is sequence of return risk and how a volatility buffer of cash sitting somewhere can actually help in these kind of times, and how that plays into the success of retirement planning.
Sure, sure. And first, just Wade is fine. You don't have to say Dr. Wade, but yeah,
I appreciate
absolutely. What makes retirement income different is the nature of risk changes. And so I'm not from the insurance world. I have my background more on the investment side. That's what that CFA is about, like investment management. But just in looking at how the investment world approached retirement income, I developed concerns, and we're really seeing that right now. And so much of my research focus has then just been on how to think about retirement risk and how tools that conventionally are not considered, like the discussion of this idea, you don't need life insurance after you retire, but in the risk management context of retirement, how potentially looking at different tools, not just using only an investment portfolio to fund retirement expenses, can help lay that foundation for a better retirement outcome. And so that idea of the buffer asset is, right now with what's going on in the markets, interest rates were at historic lows. They're coming up. That's leading to losses if people own bond mutual funds and are having to sell shares to fund expenses. At the same time, the stock market, the S&P 500 is down about 16% right now from the start of the year. That's leading to issues where people have to sell their stock mutual funds to fund retirement expenses. They'll be selling that at a loss. Inflation has picked up again, and that was the saving grace. I've been worried for a long time about kind of high stock market valuations, low interest rates, but at least inflation was low. And so that was helping the retiree not have to spend more in retirement. Now, as inflation has gotten higher as well, and the old 2% long-term inflation assumption may no longer apply, that's creating strain. And so the idea of the volatility buffer is with permanent life insurance, like with the whole life insurance type of an approach, where the cash value it's not exposed to the risk of loss in the same way that bonds are when interest rates rise, or that stocks always are. It can provide a resource to cover spending on a temporary basis during this kind of bad market environment, so that you don't have to sell from the portfolio to fund spending. And ultimately, for those who generally have comfort with an investment-based approach, not having to sell from the portfolio at a loss, you then feel more comfortable. Well, then that gives the portfolio an opportunity to recover and to make up those losses again before we have to go back to selling from it. And so the synergy you get from protecting the investment portfolio, ultimately, that's what my simulations are trying to understand, is ultimately the benefits to the portfolio exceed the costs of the insurance to give a better net outcome, especially when we consider the tax advantages and so forth of life insurance, to get a better outcome for that financial plan in retirement. And that's the basic concept.
Yeah,
so
and I've
go ahead,
Rachel.
Oh, I was going to say,
Okay.
can you take us back to, you came from the investment planning side with a focus on retirement planning. You said you started seeing some concerns. Can you just kind of outline what some of those concerns were? I know you wove them through the history that you just shared and kind of your lay of the land, but let's kind of work a little more chronologically. What concerns were you beginning to see in the retirement planning space that were causing challenges or risk for the person who's doing the financial planning?
Mm-hmm. Yeah, so in the investments world, really the approach to retirement started with research that Bill Bengen published in 1994 that gave us what we know today as the 4% rule, or the 4% guideline for retirement spending, which was, if I plan for a 30-year retirement and I have a portfolio of 50 to 75% stocks, drawing 4% at retirement and then increasing that spending with inflation subsequently should be safe. I shouldn't have to worry about outliving my assets with that diversified investment portfolio. The first kind of research study I did in the area of financial planning was, I had a data set with 20 different countries' market returns, including the US, 20 developed market countries. And I was just curious, did this idea of a 4% rule work with other countries' data? And the answer is, it really didn't. Going back to 1900, we could say it worked in the US and Canada, but not in the other 18 countries in the data set. And if you put all the international data together, around the world, the 4% rule, even though it's like we say 100% success in the US, it's about a 68% success rate around the world, putting all that international data together. And if you wanted a withdrawal rate that could have worked at least 90% of the time around the world, you had to go all the way down to 2.8%. So that was my introduction to this idea that, and this then gets into a philosophical debate of, should today's retirees focus only on US market data because we live in the US? Or should we consider the 20th century US was a pretty remarkable century in world history? And maybe looking forward from today, is it relevant to consider what's a more typical international experience with market returns? Mm. And I thought you should consider the international experience, but people would argue, I mean, this is ultimately, we don't know what the markets will do in the future. So what's the relevant kind of framework to think about it? Some people would push back on that and just say, well, we're in the US, who cares about the other data? But anyway, that just opened up this whole issue of, when we say the 4% will work, it's based on interest rates at the starts of retirement. And we can only make that determination now up to 1992, because you need 30 years of data to say the 4% rule worked. Well, interest rates have been, they're coming up now, but they've been lower than they ever were in the historical data, where we could say that the 4% rule worked from that starting point. As well as stock market valuations have been higher than they ever were in this historical data, which with interest rates, it's not controversial. Low bond yields means low bond returns. With stocks, there is more controversy. High valuations historically have suggested we should expect lower stock returns in the future. Now, that's not at all a perfect relationship, but at least if we're trying to plan a conservative strategy and we're worried about outliving our money and we want something that should be effective for our retirement, I just think that 4% rule is under a lot more strain for today's retirees than the historical data based simply on looking at US historical market returns would suggest.
Well, and you say the potential of outliving our money. I mean, you're saying it in a way that sounds very non-threatening, but what does that actually mean? If the financial plan doesn't work and if you outlive your money, I mean, what is the actual experience for that person who worked out in a 90% case? Well, their money's run out, right? They still have life to live and their money's gone. I mean, that's not a reliable situation that you want to say, I feel really good about my financial strategy, right?
Right. And so the 4% rule is artificial in the sense that no one would strictly follow that. When it looks like you're going to run out of money, you're probably going to start cutting back before that happens. It's like if you're starting to worry you're going to run out of gas when you're driving through the desert, even though you may still have a couple of gallons left, you might not feel very good at that point. And so you're going to push back and you're just going to be spending less and less. You're not going to be able to enjoy the retirement budget you had planned for in that circumstance. You'll still have your Social Security benefit, of course. And if you have, a few people still have the traditional defined benefit pension. Not many people will have that anymore, but at least they'll have Social Security. And if they did have any other protected lifetime income sources, but otherwise, as they're relying on distributions from their investment portfolio to fund their retirement spending, as that portfolio starts to decline in value, I think people just ultimately are going to feel a lot less comfortable about enjoying the full lifestyle that they may have had in mind for their retirement.
Yeah, so this brings up something else that I've known you've written about and talked about is it may be very advantageous to actually use insurance companies that are really good at risk evaluation to also fund a portion of your cash flow in the form of an income-based annuity going forward, because that ups your success level also. So can you talk a little bit about that?
Yeah, I mean, you can think about 3 basic ways to fund retirement spending. The first is just with bonds. And that's the least effective way because bonds, you can kind of, based on the age that you want to plan to live to, or not that you want, but based on your planning horizon. If I'm worried about outliving my money, we kind of get into this debate of how long should I plan for that retirement to last? And with bonds, well, I can figure out if I'm going to plan to 95, here's how much I can spend every year, for example. Now, there's 2 ways to potentially spend more than that. The first is the investment strategy, the diversified investment portfolio that, again, Bill Bengen in the Wall Street Journal recently said though Bill Bengen in the Wall Street Journal recently said he's now only 20% stocks because he's violating the assumptions behind his strategy because he's nervous about the market, which is a whole nother issue. The 4% rule assumes you stick to the strategy, but the strategy is you invest heavily in stocks to rely on this idea that there's a risk premium, that stocks will outperform bonds over time, and that will allow you to spend more than bonds alone. And then the third approach is an annuity-based approach of risk pooling, where it's the insurance company is going to invest those funds basically in a bond portfolio. But for me, if I'm worried I might live to 95 and I'm going to fund my retirement with bonds, I have to set aside the present value of what that payment or what that budget is at age 95. So if I want to spend $100,000 at age 95, well, I can account for the fact that bonds will grow with interest. So I may only have to set aside a portion of that, but I have to set aside the full spending value at age 95. Whereas an insurance company has a lot of customers and they don't know which customers will live to age 95, but they will know that as a whole or on average, about 20% of their customers say will live to age 95. And so they don't have to set aside as much to cover those age 95 payments. And because of that, they can allow for a higher level of spending than bonds could support. For anyone who's worried they might live longer than their life expectancy, which is the age where there's a 50% chance you live longer than that. So you can't really plan on your life expectancy. Anyone worried about living beyond that, the annuity will allow them to spend more than bonds will. And then the question just becomes, well, what's a better way to try to fund retirement? To rely on the risk premium from the stock market to fund more than bonds, or to rely on risk pooling through insurance to fund more than bonds? And ultimately, they're both viable approaches. This is what the RISA is, the retirement income style awareness. This idea of how do people, what's their retirement personality? Are they comfortable with the markets, or do they prefer some sort of contractual protection? Ultimately, they're both viable approaches, and it depends on what just people's preferences are between them. But the important point is, I think in the investments world, there's this notion that it's very easy for stocks to do so well that they just blow away the value of an annuity. And the reality is that's not the case, that this risk pooling that insurance can provide allows for a lot more spending than bonds in a way that's competitive with the stock market. I mean, if the stock market does very well, it would outperform the annuity. But if the stock market does average, then the annuity is going to be right alongside it in terms of the ability to fund a spending goal over a long retirement horizon. So that's where people have options about how they want to think about building a retirement income plan and what kind of approach makes them feel more comfortable. And anyone who's nervous about the stock market may not be comfortable using, as Bill Bengen, the founder of the 4% rule, has demonstrated, may not be comfortable keeping this high stock allocation throughout retirement as required by the assumptions to make that strategy work.
Let's talk about that for a second. I mean, I think you said a little tongue in cheek almost that people are a little bit nervous about the market, but let's talk about that. What about the person who said, I need higher returns, so I'm willing to trust the market. And now the market is not only not going up, but potentially losing or going down in value. I mean, how does that impact your ultimate outcome? Not just the potential for loss, but the risk that you're taking to hope that you're going to end up in the right spot because you're taking on the risk and the hopefully higher returns. But what is the impact to a person as they're having that concern that they're not going to end up where they want to, even though they took on the higher risk to get the better return in the stock market?
Mm-hmm. Yeah, it's a matter of can people sleep comfortably at night with the market volatility? And I think we've got a lot of tests about this recently, like with the pandemic in spring of 2020. How worried were you about that market downturn? The market lost a lot, but this characteristic of US historical data that doesn't show up as frequently around the world is we've always kind of, I don't know if it's luck or what, but when markets go down, they've quickly come back up. And if you're somehow comfortable keeping that in mind, so like right now, you're not panicking because you're comfortable. Okay, the market is down 16%, but it will come back up. And historically, we've seen a lot of years where the market may be down this much in the spring, but still ended up the year much higher. Who knows what's going to happen? But if you're comfortable thinking along those lines, then maybe you can get through this type of market environment and be okay. But if this is causing you to panic and abandon the strategy of if you're using this investments type strategy, then that could leave you much further behind. And it's investment volatility has a bigger impact after people are retired, because if you're having to sell from a declining portfolio, there's less left in the portfolio to recover. And so it becomes a lot harder for the portfolio to recover. And that 4% rule, it was a research simplification, but it actually creates the most sequence risk, because it's telling you to invest aggressively, to never vary your spending. And so if the market's down, you kind of dig a hole for the portfolio. You're selling a higher and higher percentage of what's left that the portfolio doesn't get to recover. But that's where, like, back to this idea of a volatility buffer, there's various ways to manage sequence of returns risk. The four basic approaches: just spend less, which is the logic of the 4% rule. There's no guarantee behind it, but that's the idea. You can just be flexible with your spending. If I can temporarily cut my expenses during a market downturn, that helps. There's different kind of volatility-based annuities, bucketing approaches, and so forth. And then there's this idea of a buffer asset, which is just something outside the portfolio, not correlated with the portfolio. And so the idea is an asset that's not going to lose value when the overall market is down, that can provide that bridge to, okay, instead of selling from my portfolio when it's down, I'll instead cover my spending through this buffer, volatility buffer asset outside of my portfolio, give my portfolio a chance to recover. And then that's another potential way to manage this type of risk.
And then how do you see the idea of inflation impacting that as well? I mean, I think often we leave off that notion that I'm going to need more income in the future to feel like the same dollars as today because of the declining purchasing power in this inflationary environment. But how does not having this buffer asset cause you to be at risk more because of inflation?
Mm-hmm. Yeah, so inflation, it has a permanent impact, because like if prices are up 8% this year, then even if inflation comes back down, I'm still kind of working from this permanent base of 8% higher expenditure needs if my spending is keep growing with inflation. So inflation is creating more risk for the financial plan, because I consider it more of it's a spending shock. It's a situation where people have to spend more than they anticipated. And that's, if I anticipated in my planning that inflation would be 2 or 3%, and now I'm getting hit by 8% inflation, it's requiring me to spend more to meet my retirement budget. And that's putting more pressure on the financial plan, because it's making it harder for my assets to keep pace and to provide that level of spending. And we think about like short-term bonds and treasury bills and so forth as the quote unquote risk-free asset when we're pre-retirement. But if I have these assets that are only yielding between 0 and 1%, inflation is 8%, I'm dramatically lagging behind inflation. My assets are not growing to even keep pace with inflation. And that's making it all the more difficult to fund a retirement spending need that may be growing with inflation.
And that makes it even less viable of an option to say, well, just take less than 4%. Let's take 2.8% this year, or let's take only 1% this year, when those dollars are feeling like less. And I think there was if we worked out the numbers you had said in your white paper, which we'll link to again in this show. We also linked to last time, about 100 episodes ago, so probably about 2 years ago on the show. You said the declining purchasing power due to inflation means that about 60% of today's purchasing power is what you'll have in 25 years. Meaning, if you plan to retire and use your assets in 25 years, the dollar that you're taking out then is only going to feel like 60 cents at that time. And if we work that timeline out about 60 years, this is with normal inflation, by the way.
Right. That sounds like a 2% inflation assumption.
Yeah. So, and then in about 60 years, that's about 30% of the purchasing power, meaning $1 is about 30 cents in 60 years, which means if you want to live a certain lifestyle, you're going to need a lot more cash to do it than what you're using today, considering that timeline. And it just makes it even harder if you're having the low stock market returns and that volatility that's impacting your portfolio during retirement.
Yeah, just your assets are not keeping up with inflation. And that's so short-term, like holding cash or savings accounts or CDs, none of that's going to keep up with inflation. And that's where you lose that purchasing power over time. And so a retirement strategy in part, and not everyone's spending will need to grow with inflation throughout retirement. And at least Social Security is inflation adjusted. So they're getting some protection there. But no, it's certainly the case that over a long retirement with inflation, it makes it more difficult if somebody's only using bonds, who's not taking on a strategy that has at least some chance to keep up with inflation. And that's where either the stock market or using insurance to cover spending to allow other investments to then be in the stock market can give a better opportunity for having the long-term potential for asset growth that can at least keep pace with inflation.
So, Doctor, let me try to be a little vulnerable here in the way I talk about this with some of my clients, because I think it's shocking that if you have a 20% drop in your portfolio, people think, well, then if I just make 20% the next year, then I'm back to zero. And they don't realize that you're not, because you're earning 20% on a lower asset. So example, $100,000, you lose 20%, now you have $80,000. If you then make 20% in your portfolio the next year, you think you'd be back to zero, but you're actually on the lower asset. So you're only back to $96,000. So you actually lost 4%. And then of course, if you took 4% off of that lower asset that year, then you're really only around 92,000 and 92,800 or something like that. So that is the thing that I don't think a lot of people realize, is that even though you lose 20, you gain 20, normally you think over those 2 years, I'm back at zero, but you're not, because you're gaining it on a lower asset. So that's a concept I think our listeners really have to understand, is the power of drawing money from an asset that's down. So if you do have a buffer account that you can let the portfolio recover from it, it'll recover a little bit more easily. So would you say that's a fair way to explain that concept?
Yeah, I mean, it's a really important point that over time, the growth rate is not equal to just the average return over time. And your example, right? If the portfolio is down 20%, so you go from 100,000 down to 80,000, you would need to then have a 25% gain to get back to where you started. And if you're furthermore spending from the portfolio, that's even further ramping up the gains that you would need to offset so that you can get back to your initial portfolio value. And so growth rates are less. And I think there's a popular radio host who talks about 12% stock market returns, but he's completely confusing this point. That's not a growth rate over time. That's a historical. I take all the historical stock returns and divide by the number of years. I get 12% on the S&P 500. But if I'm going to invest in the S&P 500, the historical growth rate is more like 10%, not 12%. But and then if I want to know about purchasing power, I'd have to extract inflation out of that. Then I'm getting down to around 6.5 or 7% in terms of inflation, in terms of keeping the same purchasing power. And that's then just the average. And so you can't necessarily rely on an average over a short period of time, because market volatility and risk is there. And that's if the timing of your retirement is such that you retire and then markets start going down for a while, that's back to the sequence risk is, even if the market recovers, and if you're spending from your portfolio, it becomes a lot more difficult for your portfolio to recover. And it's exactly this point that you're talking about.
Yeah, it's a sequence of return risk. I think it's one of the things that most advisors don't educate their clients on. They're only looking at that average return, and they somehow find comfort in that. And I don't think that's very comfortable, frankly. Let's talk a little bit also about, in your research, when you have a couple that they can actually afford to spend more during their retirement years if they have a way to fill the bucket of assets back up in a well-designed life insurance product, because the surviving spouse then can feel good about the assets being filled back up upon the death of the other spouse. So that means then they can actually spend more along the way and have a more fruitful retirement. So what does your research show on that?
Right. So, and the issue is, like, if anyone's worked with some financial planning software that reports a probability of success, something like that, and maybe was told, build a financial plan that will work 90% of the time. What people may not realize about that is assuming a low rate of return, because if you're doing it investments only, that return has to be low enough that 90% of the time, the realized return experience will be better, that you would actually get a higher return and you have money left over. So that sort of investments approach forces people to spend less to have a high probability of success. Mm-hmm. And that's where, like, to the point you're making, using insurance as part of the retirement plan, you have contractual protections behind what you're doing. You're not having to be overly conservative, and not just about market returns, but about my longevity, forcing me to spend less to make sure I don't outlive my money. And so the scenario you described specifically was, we have a couple, they're looking to support a retirement income goal throughout their retirement. They could consider a joint life annuity, or they could consider a single life annuity on one of the individuals that's going to pay quite a bit more than joint life. Having a joint life annuity is another way to effectively incorporate life insurance. But if they had life insurance on that individual, they could go ahead and get the single life annuity, get a much higher payment from that, knowing that the life insurance is backing that up. And then if something happens to that individual, and they say they bought an annuity that was equal to the premium they paid was equal to the death benefit of the life insurance, they now have the death benefit of the life insurance replacing that asset to the household. And so if the spouse outlived that person, the spouse could then consider, do I want to then purchase a single life annuity myself at that point? If that individual outlived, it's just then the life insurance becomes that asset as part of the legacy for the household. But having that sort of integrated approach to cover spending through insurance, not with all the assets. I think another common misconception people have is whenever we talk about an annuity or an insurance or something, it's an all or nothing type of decision. And that's not the situation here. It's let's cover spending through insurance, and then that can free up some discretion. So with some of our remaining assets, we might feel more comfortable investing them in the stock market, which ultimately could give us a much better retirement outcome in terms of getting growth through the stocks, not being exposed to the sequence risk because we're covering spending through the insurance, having the life insurance to back up the annuity, being able to more effectively meet spending goals, and having a much higher chance to leave a larger legacy at the end as well through this sort of integrated strategy with insurance and investments.
And then effectively what happens is your annuity or your life insurance becomes your bond portfolio.
That's how I like to frame it always, that it's thinking in terms of annuities and life insurance, cash value are both part of my bond holdings. And so bond mutual funds are not a very effective retirement income tool. But if I can have less bond mutual funds and have more fixed income through insurance or more bonds through insurance, that's the way to think about it. Not necessarily having to sell my stock investments to buy insurance, but replacing my bond investments with insurance. That's the way that can help create these better, more effective retirement plans.
That's the thing that opened up my eyes from your research, is then you actually can have, if you take care of your basic spending needs, then you can actually have your equity portfolio be a more aggressive portfolio, and thus have a situation where you probably won't outlive your money, or you could have even a greater income stream in retirement that you can enjoy. And that's what when I read your paper and when I saw you talk in Colorado Springs, I thought this is just a great thing that really, if you're a true investment advisor, true fiduciary, you really need to take all these things into consideration and not just a 60-40 portfolio where you buy, hold, and hope that, it works out at the end.
Yeah, in a pure investment context, bonds are usually, there's this group called asset dedication. I really like their analogy. It's just bonds are stock light. They're part of the diversified portfolio. Their only job is to reduce the volatility of the portfolio, but they're still volatile, just like stocks are. Long-term bonds can be just as volatile as stocks. But so when you're thinking about retirement income, where you're trying to fund spending needs, that's where instead of using bonds as just a less volatile version of stocks, why don't we use bonds to actually fund retirement spending needs? And then being able to get that risk pooling aspect through insurance, so it's bonds plus risk pooling, that can be a more effective way to fund the spending needs. That then creates risk capacity, which is just this idea, if I have my spending covered, I can take on more market risk because my lifestyle is not dependent on getting high market returns. I can weather a stock market downturn. I can panic, not panic. I can stay the course because my retirement isn't dependent on getting the high stock returns. And then I really have more opportunity to benefit from stocks for the long run because they're not essential to meeting my retirement spending because I have insurance to do that. And that's where by being able to leave my stocks alone, then I'll have more later in retirement, or I can help fund more legacy that way. It's just, there's a lot more flexibility for how to approach not having to rely on this volatile investment to fund my basic retirement spending because insurance is playing that role. And so not everyone will feel more comfortable, but you have the capacity to then feel more comfortable with stock investments because they're not essential to meeting your retirement spending need.
I think that couldn't have been stated better. Bruce, I really want to highlight this for someone listening. I think we've probably said it about 6 different ways, and I was going to point it out even before you did, Bruce. And I'm so thankful that this particular concept is becoming very prominent on this show. When you have security and guarantees, you can do more because you're not dependent on the performance of that investment as much as if you didn't have the guarantees. It's like if you didn't have a foundation, then you're going to feel a lot more unstable in building the house. But when you do have a strong, solid foundation, you know that the ground beneath your feet is solid and you're depending on that for income and for some of the things that you know that you're going to need, then you can build a much taller skyscraper, even if you will, because you have the solid ground.
So Wade, put your PhD in economics hat on, and I know this is probably not a fair question right now, but I'd like to hear your. There's some people that are saying because of the way the stock market actually went up because of the amount of money that was pumped into the system, that really until we get back into normal economic viability, that we could have another potential 2000s where the returns in the 2000s were basically flat. Do you have any opinion on that for the next 10 years on looking at stock market returns?
Yeah, I mean, I think it's possible. Ultimately, we don't know what the markets are going to do. And with this high market valuation environment, for a long time, that type of modeling would predict lower stock returns, which we've somehow managed to avoid for quite a while at this point. But the way I approach it is I'm still not afraid of stocks. I am further away from my retirement date as well, though, to be clear. But I'm not going to assume stocks are going to grow at their historical average numbers. I'm going to build a financial plan where I'm assuming a much lower rate of return on the stock investment. Like in my own personal financial planning, I'm just assuming a long-term growth rate of 4.25%. So, and that's including the inflation. That's not the real numbers. And I'm going to have to modify because the inflation was 2% of that, but it should probably be higher now. But anyway, it's not to necessarily be scared away from stocks, but to certainly make sure your plan can work if stocks have a lower return in the future than you might want to pick just by looking at their historical average numbers. And that's just a function of the valuation in the stock market and how based on historical performance, when stock market valuations have been high, subsequently stock market returns have been lower and even close to zero in some cases. So that's how I would approach it. Not that I'm going to try to time the market and abandon stocks, but I'm just going to work from the assumption that stocks will provide a lower return. And so I can't rely on 7 or 8% type returns for my financial plan.
Well, that makes me feel good because I've been modeling out 4% with a 2% inflation.
Yeah, we're
I
pretty
probably,
close.
I probably need to, bump that in long-term inflation up a little bit, but I think people can sleep better at night knowing that you're not presuming, the upper parts of the market that were there historically at 7 or 8%, where a lot of financial advisors have historically modeled. So getting that down, I think right now is probably a wise thing to do.
From here, we have a few minutes left before we have to wrap up the show. And what I would like for you to do is just kind of talk from your perspective on the difference between what many people would say, buy term and invest the difference versus having whole life, and the advantages that you get from having whole life. And I want to preface this a little bit by the idea that I think this stems from the whole concept that life insurance is about a need only. And if my need is to pay for a mortgage if I die early, and my income is no longer being provided to the household, then there needs to be something to fill that gap, which is usually term insurance. And the need for that type of concept about life insurance at all is over when I stop earning an income, or when I slow down and stop having as much income coming into the household based on my work and my career. So I think a lot of times that this idea can be, well, if I just get term insurance, there's a lower cost of that insurance. My need expires at age 65, and I've paid less for this insurance product. I'm over 65 now, I'm in retirement, I no longer have a need, and I've paid little to get that. And so I was able to invest more of my dollars. Whereas you're saying, hey, there's tremendous advantage in having whole life insurance, because when you have it in retirement, you have this ability to have a volatility buffer. This asset can act as your legacy. You can do so much more when you have the whole life insurance. But I can hear somebody saying, yeah, but didn't my need expire already for life insurance? And yeah, but if I did the whole life insurance, from that perspective, I paid way more to get the life insurance. So now I had way less money to put into investments. What would you say to the person asking those specific questions?
Mm-hmm. Yeah, I did, because I'm from the investments world. I was skeptical at first. And when I first started looking at it, there was some naive analysis out there of basically just introducing an extra life insurance policy at retirement. And I was like, well, hold on a second. If you're funding permanent life insurance, the premiums will be higher. You won't have as much in your investments. So that's why when I did this research, I backed up and looked at different versions of the white paper, like 35-year-old, 40-year-old, 50-year-old. But at that point in their life, they realize they do need life insurance for the traditional reasons we hear about, to provide protection to the family, to replace their salary if something happens to that individual. And so then the question they're asking themselves is, should I buy term and invest a difference to provide that protection to my family? Or should I use permanent life insurance to provide that protection to my family, but to also be thinking ahead to retirement? And if I could then use that in different ways in retirement. And so permanent life insurance, the premiums are much higher. And by doing it this way, I'm able to back up and say, indeed, you're not going to have as much in your investments if you're using permanent life insurance. So when you get to retirement now, if you bought term and invest a difference, you have more investment assets, but you don't have any insurance at that point. And then you're just vulnerable to, okay, if I want my plan to work with a 90% success rate, I can't spend very much. If markets do well, I just end up leaving a huge legacy at the end and so on. Versus I now have permanent life insurance. I could use that as a volatility buffer, and that will allow me to spend at a much higher level from my investments, because it creates this synergy to help protect my portfolio in a market downturn, or I could simply use the life insurance to support purchasing an annuity that will then provide a replacement for that single life on that single individual to get a much higher level of spending throughout retirement. There's a lot of different options, and the simulations, it's if the stock market does very well, like at the very top end of the distribution, the investments only strategy, it doesn't necessarily come out ahead because you're going to be spending less throughout retirement, but you might leave a much larger legacy at the end. But all the strategies include a role for stock investments. So it's like maybe like and when the stock market does really well, investments only, you're spending less throughout retirement, but then you leave $15 million of legacy versus with an integrated strategy with insurance, you might only leave $12 million of legacy. But that's only for a small portion of the possible outcomes when markets do very well. For the majority of cases, and in particular, when markets don't do as well, which is what we want to protect against, you're spending less throughout retirement with the investments only approach, and you're leaving a larger legacy at the end as well. That using insurance as part of the planning process not only lets you spend more and enjoy more in retirement, but also more often than not, leave behind a larger net legacy at the end and it's through the insurance aspects of it, but it's also through the tax advantages of, especially with life insurance, structuring to not have it's proceeds from a loan. So it's not going into adjusted gross income. It's not impacting your tax bills. It's not impacting the taxes you pay on Social Security benefits. It's not impacting the Medicare premium surcharges that higher income people need to pay and so forth. Plus so it's the tax advantages plus the insurance risk pooling advantages that work together to help provide that better retirement outcome in the majority of cases, and more importantly, in the cases where you need that protection because markets are not doing as well.
I think that's really valuable for someone to hear, especially because of the pervasive thinking about life insurance. And, we are often talking about whole life insurance from the vantage point of infinite banking and from a position of saying, here is a wonderful place to store cash. You have capital that you're able to access and borrow against for purchasing an additional investment or for your emergency fund, or as we talk about your emergency and opportunity fund as well. But I love to hear from the person who's looking ahead towards retirement, what specifically is the best way of thinking about whole life insurance as a asset and as a benefit to your planning that really makes things do better. And so I love your white paper. I actually don't think I have the name of it right here. I do. Optimizing retirement.
Go ahead. Okay, that one. Well, I have the one that I was referring to as integrating whole life insurance into retirement income planning.
Yeah, there's been multiple versions of it.
Yeah, I love that one. One of the things, Wade, that I want to get your perspective on is that when a person is really trying to make a decision financially, they also have an emotional aspect of that particular decision. And that's where you keep referring to it, I think, as a risk analysis, but it's the person's own risk analysis, which is an emotional part of that. And so that how do you advise people and families or the people that you teach to take that emotional piece into because your research is so based upon the math and the Monte Carlo simulations. Mm-hmm. But when I was at the Jackson National thing yesterday, and they said a 90% chance of it being successful. Well, there's people with mindsets that, well, that's great. 90% is great. And other people are saying, you mean I'm going to fail 10% of the time? Mm-hmm. And so how do you advise the people that educationally, look at your stuff and you teach? How do you advise them on the emotional aspect of all this?
Well, that's actually been a big area of research focus for me over the last couple of years with this idea of the retirement income style awareness, where we really try to understand what sort of trade-offs are involved in retirement, and then how might people make a preference for that. And ultimately, this is work I did with Alex Murguia, where we found there are these two primary factors for retirement. And the one is, am I comfortable with relying on market growth to fund my retirement? We call that probability-based. Or would I prefer contractual protections to help support spending, at least for my essential spending in retirement? We call that safety first. And then the other primary factors, which surprised me, I wouldn't really have predicted this one, but it was optionality versus commitment. Do I want to keep my options open as much as possible to make changes in the future? Or am I comfortable committing to a strategy that I know will solve for a lifetime need? Mm-hmm. And the really fascinating part of this research was when you mix these two factors. So if you're probability-based and optionality-oriented, that is describing the total return diversified investments only type of an approach. I'm comfortable with the markets and I don't want to commit to anything. I want to keep my options open as much as possible. Alternatively, a safety first commitment orientation. I want contractual protections and I'm comfortable committing to a strategy. That's much more the world of integrating insurance with investments. And what we ultimately found is that this has now been done as a nationally representative study of 2,800 Americans. About a third of the population seems to be comfortable with the investing only type of an approach. Even though the consumer media almost always focuses on that as being really the only viable approach to retirement. So at this point, I'm purely agnostic on this. For the third of Americans who prefer an investments only strategy, I'm fine with doing that. But ultimately, 2/3 of Americans are looking for something different. And that's where I think it's very important to make sure or to make clear that there are different options. And the math is certainly behind the integrated strategy with insurance and investments. But it's behaviorally not going to be for everyone. But for the people who it is appropriate for, yes, the math supports it. Plus, if it helps you to sleep better at night and helps you have a more enjoyable retirement, then it's a completely viable strategy that people need to understand is available to them. And so I really now view retirement income. The first step of building a retirement plan is to start thinking about what sort of retirement style do I have? What kind of basic approach do I want to use towards building my retirement income stream? And again, for the third of Americans who want to be investments only, go ahead. But for the other 2/3, there are viable and arguably mathematically better ways to build a retirement income plan than an investments only approach.
Have you written a paper on this retirement style?
We've got several research studies on it now. And actually, in the other big pandemic project of mine was writing a new book, the Retirement Planning Guidebook, which is a comprehensive look at all the different aspects of building a retirement plan. Chapter 1 is about these retirement income styles. And on page 15 of the book, there's a link if people would like to actually take this questionnaire and get an understanding about their retirement style and what kind of retirement strategy might resonate best with them in terms of the way their personality is designed for how they want to approach a retirement income plan.
I think it's very important for people to understand their personality, because if they don't, then there's resentment that sets in later on. You're hiring an advisor that's trying to take in all these things. But I found from my experiences, some advisors really don't take into the retirement style and say, oh, don't worry about that. I've got it taken care of. Just don't worry about it. Look at the numbers. It's going to work out. And then other ones say, well, just do whatever. We'll just do whatever you want. Whatever you want, we'll say. And then of course you're not advising them, because that's your part. That's your role. That's why you're getting paid, to protect people from themselves. And so it really, I try to be in the middle ground, and our firm tries to be in the middle ground. We try to be somewhat, evidence-based, but also take the retirement styles into consideration and be a true advisor. And that's where the sleep at night thing, I think, and you avoid the resentment in the future, or constantly going over why you're doing something.
Right. And not just the resentment, but also the risk of abandoning the plan when there's market volatility, which is like, for example, Bill Bengen, he's now talking about market timing and things as justifying why he's gotten out of the stock market. But the market timing does not have academic support behind it. And ultimately, I'm just concerned. He's the poster child of the investments only approach to retirement. And I'm guessing if he took the retirement income style awareness, he may not be a total return style. The strategy he created may not be the right strategy for him. And that's manifested through the fact that he's abandoned it when markets got volatile.
I always tell people in a timing situation, you have to be right 3 times. You have to know when to get into the market. You have to know when to get out of the market. And then you have to know when to get in the market again. If you're confident that you are going to be correct all 3 times, and that's only in the one time you're timing the market, then several years later, you're going to try to time it again. You have to be in the same situation again. The research shows, we don't have time to talk about this, and I don't know if you've actually done the research, but the research I've written is that timing the market just doesn't work unless you're in that outlier where there's a luck component into that situation.
Yeah, no, that research has all been established since the 1960s, so it's not even really an open research question by the time I came along.
But yet it still happens on a daily basis, not only with the consumer, the public, and now that we have all these not self-directed, but investor-directed accounts that they can get in and just direct their own brokerage account, they don't have somebody in their ear telling them, stop trying to time the market, which brings in even more volatility into the market. But I still see financial advisors who do not stick to the strategy that they agreed on and said, okay, yeah, I think I'm smarter than the market and I'm going to time the market for you.
Mm-hmm.
There's so much more. We are going to be having you back on the show. We're going to be talking about reverse mortgages, and that's probably in about a month or so. So if you're listening today, Dr. Wade Pfau will be back. Please hold your questions or send them to us in advance. You can email us at hello@themoneyadvantage with questions for him specifically. But I think the big picture that anyone can take from this conversation is, first, you need to know what are your specific goals. Then you need to be working with an advisor that understands and respects and can help you with your specific goals, do the most with your money so that you have the most, the best outcome in the widest range of circumstances. And that often involves some form of certainty. And so I really want to thank you, Dr. Wade, for doing so much research and substantiation and really modeling what these financial simulations work out to and how we can be in the best position to have guarantees to not just work out in 92% of the time or 90% of the time, or have to just reduce income to a place that it doesn't even make viable sense. So thank you very much for just your passion to continue this whole pushing forward this whole field of retirement planning and making it better for people who have real lives with real income needs and real expenses in those later years. Thank you very much.
Well, thank you. It's been a pleasure.
You've also, just real quick, if somebody wants to get a hold of you, find out more, get your book, where do they go? I believe that is retirementresearcher.com. Is that correct?
Yeah, that's my home base, retirementresearcher.com. And the retirement planning guidebook is easy to find at Amazon. It's been showing up as the first listing at, once you get through all the sponsored things, the first organic search listing for retirement or retirement planning. You'll see the retirement planning guidebook.
That's awesome. Well, that's an accomplishment for you as an author. So congratulations on that.
Thank you.
Thank you so much for being with us today, Dr. Wade Pfau. If you are looking him up, that's PFAU. Is that correct?
That's right.
All right. Thank you so much for listening today. And you can find us at themoneyadvantage.com. If you have questions, feedback, comments that you want to share with us, or you want to dig into your specific situation, you can book an appointment with our advisors at themoneyadvantage.com. And please remember, in closing, success leaves clues. So model the successful few, not the crowd, and build a life and business that you love.